let's get on board Sanjay Parekh, who's the founder and CIO of Soham Asset Managers, who's joining us now to weigh in how the markets are going to shape up. Hi, good afternoon, Sanjay. Thank you so much for joining us today.
Hi, good afternoon.
Sanjay, so tell us, the verdict is out. If you look at the RBI stance, there is a 25 basis rate cut, and with the earlier liquidity infusion, and now with the stance also changing to accommodative, and what the RBI governor said, it's very clear that RBI wants to have abundant liquidity in the system. Going ahead, how is this likely to shape the markets? Also, inflation has come off sharply. The food prices that were sticky earlier on, that has also moderated. So going ahead, if you put aside the tariff war news, one cannot overlook that. But if just the Indian picture, the picture for India has to be looked at, what do you see for Indian markets now?
Yeah, so you got it well. RBI did a phenomenal job. The respected governor, after taking over, clearly infused liquidity that was required through CRR cards or swaps, or through OMOs, etc. So there's a very, very good liquidity provision they have done. Now followed up with another repo rate cut and changing the stance from neutral to accommodative and clearly directionally telling that we are pro-growth now. And the best part is the inflation is well in control for them to do this. Because if inflation were to be higher even by, let's say, 50 bips or 1% more, then they would certainly have not accelerated it, and may not have changed the stance. So now it's a pro-growth stance, and of course in a balanced way, which RBI always does. But it will really help, to stimulate a growth slowly because the world is quite in a chaotic scenario. So in that chaos, even inflation, you can't have a very long-term view because if there are some supply chain disruption, it can impact us as well. So that with the chaotic world that we are into, we are certainly in a very, very good shape, and RBI has been very, very helpful to the markets.
Certainly seems like, and Sanjay, the comfort that the investors are finding, at least in today's trading session, is the defensive pack. Case in point being the staples as well as some of the other consumer good companies. Help us understand that at this point in time, any sector preferences that you have or any comforting area that you are spotting at this point?
So one is, one is what is happening in the global scenario. And very clearly, each of us would look at what is our global exposure to our portfolio. And as of now, obviously, the less it is better. So, and more you are domestic driven, it helps. But only, caveat is that while global scenario is quite chaotic and we don't know what will be the second order effect. While, initially we are better placed, it's coming out very clearly and we could benefit also on a relative basis. But what it could, the ramification on global growth, the global slowdown, if China has excess capacities, how would it try to push that supply, and how do we protect ourselves as an industry? We'll have to see, and if the global growth slowdown is there, there could be impact on fund flow as well. So we need to be very navigating it very carefully. A little unfortunate is that our growth rate in this quarter will be flattish. We are coming out of low growth, and this year, full year, maybe we'll end up with 6-7% growth rate for Nifty, and it can only slowly recover in this environment. So, we've seen downgrades in earnings for even 26, and right from 1200 to now 1170, 1160, and then 27, they range from 1300 to 1350. So the good part is there is a good time correction that we're going through, but we are in a chaotic world. So I think it will be a very slow process where as our earnings recover, as the globe gets better, hopefully, and then there's more confidence, and then the market looks up. So that's how we think the price risk we think is done by and large. We will never say no ever in this environment. but the slide will be slow and gradual.
Sanjay, also, I would want to get a sense of on how do you, where are the pockets of value for you? So now large caps have corrected considerably. There is a valuation comfort there. Would you be buying into this mid space just yet? Given the correction that we have seen, would you be wary of it? And if yes, then within the large caps, what are the sectors that you are looking at?
Yeah, so we are, our positioning is we are domestic overweight, global underweight. So our exposure to global like IT is 6.5%. Pharma, we strongly believe will be insulated, but today, Trump did make a statement that even that is not insulated. So we'll have to go through it. But even if it comes in the measured way, they'll be able to pass on is what we think. So pharma is again where we have around 3.5%. But the rest is all domestic. So domestic plays, certainly there could be impact on demand, like discretionary space. If the overall markets are weak, you do see some impact on demand. And there, anyway, TVs, you're able to see that growth rate are rapid. Financial, I think, are relatively better off, while they also will take some pain because of this rate cuts, because the asset repricing happens faster, while the deposit repricing takes time. So we will see some more pain there as well in terms of growth rate, but they are on asset quality piece, they are better placed. So in this environment, financial looks far better. Telecom is again one area where we are overweight. Capital goods, we are overweight because there again it's more domestic, except of course the largest name has exposure overseas, and there could be some ramification of crude being lower and impact on demand on the largest player in capital goods. But by and large, we think we will sail through there. And then, some of these global, I mean, oil and gas, we are underweight, we are zero. FMCG, our problem is, again, quarter is weak and valuations are not cheap. So we would not want to hide there. And that's the
Yeah.
overall stance we have.
All right, Sanjay, with this, we let you go on that. Really appreciate you taking the time out and speaking with us and helping our viewers understand that how to navigate this volatility and which are the sectors that one should be looking at.